China has been doing incredibly well for decades now. Its cities look like this: futuristic skylines, endless highways, and mega projects that have stunned the entire world. According to this Forbes article, China used more concrete in 3 years than the US did in the entire 20th century. But behind this glittering growth lies a problem. A big problem. So big that China now sits at the edge of an economic crisis. Today, China's local governments are unable to pay salaries on time, and China's debt to GDP ratio has ballooned to over 300%. So how did the world's second largest economy land here? Let's find out in this video. The story of China's rise and transformation began in the year 1979 with Deng Xiaoping. Deng Xiaoping opened up China's economy to the rest of the world, and it turned it around completely. A great example of this transformation was the city of Shenzhen, where under his leadership, a special economic zone, SEZ, was established. The result? Average income in Shenzhen went from under $1 a day in 1979 to over $30,000 a year. It was an economic miracle. We've already made a video on this if you're interested, so do definitely check it out. Anyway, as China was progressing and prospering, its people were getting rich as well. And when people had all this money, they were looking for avenues to invest their money. In India or elsewhere in the world, when it comes to investing, you have a variety of options like stocks, mutual funds, pension funds, real estate, and so on. Now, even if you invest in mutual funds or pension funds, your money is indirectly going into the stock markets. But in China, the stock markets work very differently. For starters, it is dominated by retail investors like us, ordinary people trading daily, instead of institutions like mutual funds or pension funds. This makes it much more volatile, almost like a casino. Second, government policies play a huge role. Stocks can suddenly rise or crash depending on new rules, crackdowns, or political decisions. For example, when Beijing tightened rules on tech companies, giants like Alibaba and Tencent lost billions in market value overnight. Third, many big Chinese companies are state-owned, which means their main goal isn't always to make profit for shareholders, but to follow government priorities. And unlike in India or the West, where investors trust long-term growth stories like Infosys, Reliance, or Apple, in China, the trust is weaker because of lack of corporate transparency and regulations which can change anytime. As a result, over the last 25 years, while India's index Sensex is up 2,100%, China's Shanghai Composite Index is up just 80%. Further, there is no option to invest in international stocks either. China has very strict capital controls, which means ordinary people can't freely send their money abroad to buy international stocks, bonds, or properties. So in China, with saving deposit rates very low and stock markets unviable, real estate became the default investment option for middle-class Chinese families. Over 70 to 80% of China's family wealth is invested in real estate. It seemed very promising too. With increasing per capita income and China's population, the real estate story of China only seemed to be getting bigger and stronger. In fact, seeing this growth, China also started seeing a lot of global investments pouring into the Chinese real estate market. Now, not only 70 to 80% of the Chinese family wealth is into real estate, but China's real estate market also accounts for 25 to 30% of China's GDP. But this also makes Chinese families and China's economy heavily dependent on this sector. Any hiccup or sneeze here could cause problems. And what happened next was more than just a hiccup or a sneeze. It was a heart attack. In 2021, Chinese real estate firm Evergrande officially defaulted on its offshore bonds after missing payments. This triggered what Fitch Ratings called an event of default, and it sent shockwaves across the global economy. Now, the fall of Evergrande was big, very big. Evergrande at this point was the largest property developer in China, with over 1,300 real estate projects in over 280 cities. For comparison, India's largest property developer, DLF, has around 185 projects. This makes Evergrande almost 10 times bigger than DLF. Further, with a total debt of over $300 billion, Evergrande was the world's most indebted property developer. Now, the failure of Evergrande in itself wasn't the problem. It was the symptom of the problem. There were many other companies and real estate developers like Evergrande that failed as well. So how and why did this happen? We already know that the absence of other avenues of investing in China caused a massive demand for real estate. Real estate developers like Evergrande would borrow money for land acquisition, then they would sell these homes even before they were ready to the buyers. And then they would use this money to pay back lenders, build the homes, and repeat this strategy with other projects over and over again. Now, this strategy was working, which is precisely why companies like Evergrande became so big in the first place. But in order to work, it relied substantially on two things: perpetual borrowing, and finding buyers. Sensing a bubble in the real estate sector, in August 2020, Beijing introduced the three red lines policy. This basically limited or capped how much debt property developers could take on, based on debt to equity, debt to assets, and cash flow ratios. As a result of this, real estate developers couldn't take on more debt and they thereby could not finish their ongoing projects. What also came to haunt them at the same time was a substantial decline in the number of buyers. These developers had been building for a growing population, but China's birth rate and population, despite reversing the one-child policy in 2016, had continued to decline. In 2023, birth rates dropped to just 9 million, the lowest in modern history. Further, many estimates say that China has overestimated its population by 100 million. So on one hand, developers couldn't finish projects because of lack of debt or funds. On the other hand, there weren't enough buyers. The result? An oversupply of homes. Now, oversupply is fine, but the extent of oversupply is going to shock you. China has over 50 ghost cities and over 65 million empty homes. Let me repeat that number. 65 million empty homes. 6.5 crore empty homes. With 4 people in each of these homes, it can accommodate 260 million people. That is more than the population of 191 out of the 195 countries in the world. But the worst part is that this is not where the story ends. So far, 2 of our questions still remain unanswered. How did this lead to China's debt to GDP ballooning to over 300%? And why are some of China's local governments unable to pay salaries on time? On paper, China's debt to GDP ratio is around 85%, but this is far from reality. Let me explain. China is divided into 23 provinces, and each of these provinces has a local government. Now there is a competition between these local government officials to deliver the highest growth rate. The one who delivers the highest growth is more likely to be promoted within the CCP, the Chinese Communist Party. Chasing this growth, local governments launch new projects and raise money to develop more and more. But there is a problem. The problem is that these local governments are not allowed to borrow. You may wonder, in that case, how do they raise money to develop? This is where local government finance vehicles, LGFVs, come into the picture. These are financial instruments created by local governments which allow them to borrow money. The local governments take the land that comes under their province and transfer its ownership to these LGFVs, and these LGFVs then go to banks and use this land as collateral to raise money. Using this money, they build all the crazy infrastructure that we see to propel growth. Now, good infrastructure brings economic activity, and with it, tax revenue. The expense is the development and maintenance cost, and the income is the tax revenue. But what happens when you overbuild? You have inventories and ghost towns and no economic activity in the region. With not enough people and economic activity, there is not much tax revenue pouring in, and a lot of what pours in just goes into interest payments to the bank, creating a vicious cycle. This debt does not get stated in China's debt to GDP figures because the debt is not directly taken by the local governments. Instead, it is taken by the local government finance vehicles, LGFVs, created by them.
Wait a minute! Who are you?
Now, even though the numbers don't show it, the impact is felt everywhere. This is exactly why China's local governments have been even struggling to pay their own employees. So as you can tell, this is a crisis of epic proportions. China's story has always been one of scale. The fastest growth, the biggest cities, the tallest skyscrapers, but that very scale has now turned into its biggest weakness. What started as a simple housing bubble has spiraled into ghost cities, over-leveraged developers, local governments drowning in hidden debt, and even officials struggling to pay salaries. And remember, this is not some small country. This is the world's second largest economy that we're talking about. If China stumbles, the ripple effects won't stop at its borders. Global trade, commodities, manufacturing, and even financial markets could feel the shockwaves. The big question now is, will Beijing find a way to stabilize this crisis, or are we watching the beginning of China's decline? Let me know your thoughts in the comment section below. I hope you enjoyed this video and found it useful, and as always, thank you so much for watching.